We're going to spend the next 40 minutes or so chatting about one of our favorite topics, which is the growth of family offices and their investing outlook for technology, digital assets, and blockchain. But before we jump into that, just a quick little highlight about Keiretsu Forum and our global investment organization, and excited to be a partner with Link2 in these events, and chance to bring everybody together online, a chance to learn. And that was Randy's vision 20 years ago, get a group together that are a lot smarter than he is, to be able to look at investments and be able to see how to find opportunity and look to mitigate our risk. So Randy, thanks so much for being on today. I'd love for you just to say hello and a little bit of background and maybe a little bit of a year-end thought here as we go into 2022. Certainly, you've seen a lot of technology trends, ups and downs, from the internet to mobile, telecom, Apple right in your backyard there with the iPhone all the way through, and certainly exciting times ahead. So thanks so much for being on, Randy.
Randy,
you got to unmute.
Got to unmute.
Okay, can you hear me now?
We sure can. Go ahead.
Sorry, I said the last panelist was very inspiring regarding Etienne when he said it's your tuition, when you lose some money in the crypto space or whatever. And that's why I started Keiretsu Forum 22 years ago. I was tired of losing money, and I really needed mind share and swarm intelligence. So selfishly, I needed smarter people around me, as you alluded, Nathan, and we're blessed now to have 60 locations around the world. And not only we're giving capital to entrepreneurs, but we're giving resources, and those are all pro bono. And we want to help companies, obviously, the next step. And what's going on in our world? It's been a virtual world, probably for most of you. But we had 317 fundings last year, over 20% more than last. I think because our members had more time and more bandwidth to really focus on our great companies, and not only focus with capital, but focus with resources. And you're going to hear later from one of my other general partner, Matthew Lamuro, about the blockchain space. And we're blessed, and he's going to be talking about our Fund 1 at Keiretsu Forum. We have obviously 7 different funds, from topping off our great deal flow around the world to real estate fund. But our blockchain fund now has been rated on the fund-to-fund basis #1 in the world. We're 63% net of fees. And so we're very proud of that. And that's all because of Matthew and Allison and Nathan. The Keiretsu Forum is a membership community globally, here to help each other be better investors. And there's no vested interest. So when a member does invest, he or she obviously enjoys total access to the company. But the leverage point is that we do negotiate. We want to win, obviously, with evaluation. We want the entrepreneur to win. But we're here to help each other be better investors and smarter investors. And I want to applaud my partnership with Nathan in the last 15 years. Not only our chapter, led the chapter to the Northwest, but he's going through the Rockies. And it's really great to see, obviously, the growth in that area and the growth, obviously, throughout our regional network around the world. And last night we had a dinner, and we're coming out. And next year, Nathan, I know you are going to be trying to get out more socially to our members, and we're blessed to have over 3,000 members. So let's come together, let's discuss opportunities, and obviously go into space. We're all blessed to be happy Link2 investors. Congratulations, Karim and Bill. Let's keep it going. Hopefully, it's going to be a unicorn third quarter, and it's a real blessing that we get to see great opportunities that we'll see today. Back to you, Nathan.
Thanks, Randy. Appreciate you being on, and all of your leadership here the last 20 years as we built our global community and now expand into working with family offices and working with blockchain and trying to stay on the frontier of these opportunities. Just a fascinating panel that just wrapped up, and looking forward to the continued discussions here today. So I'm just going to give a quick little overview of our topic today. We'll have some personal introductions from each of our panelists. So Andrew, get ready, and then Craig and Nick we'll roll through. We'll do some personal introductions in just a moment. This is meant to be a lively little fireside chat among us about the opportunities in the market today and what we're seeing out there. And obviously, family offices are at a tipping point in our economy. We see them showing up more and more as the size and number of family offices grows. Approximately 17,000 family offices throughout the world. So, what is a family office? It really just means people having control of their own money, hiring their own team, building their own investment portfolios, not just taking a prescribed formula from Wall Street, but really being angel investors, being entrepreneurial investors, really making sure there's a portfolio alignment with your core values And then obviously there's an opportunity to get the younger generations involved and try to preserve wealth, because unfortunately it's rags to rags within a couple year generations historically. So being able to preserve wealth and be able to maintain that entrepreneurial spirit. And there's been a huge growth. About 70% of the family offices were just started in the last 20 years. And we've really just begun the great transfer of wealth from our baby boomer generation here. 10 trillion in assets, another 65 trillion to transfer here over the next 15 years. So it's an incredible time, and it's an incredible amount of capital. So where's that capital going to go? How's it going to be invested? It's historically been a very inefficient, fragmented process, very siloed, but that's changing. And certainly crypto and technology is doing a lot to bring these opportunities to the forefront, build collaboration, build the opportunity to invest together. And so very pleased to have our group here today. And we'll start off with Andrew, then we'll go to Craig and Nick. If you guys could just take a moment with a personal introduction, a little bit on your background to set the stage, if you could, for our discussion today. Go ahead, Andrew.
Thanks, Nathan. And Randy, great to be here. So Andrew Romans, I founded a number of startups in the 90s and early 2000s, raised about $300 million of venture capital funding as an operator, returned that capital with a return with an IPO and an M&A and a colossal shipwreck in there. And then I started a venture capital firm, started investing out of 2014, and Fund 1 is about a 7x cash on cash return. Fund 2 is at about a 4x now, but we think it's going to double or triple. So we're really expecting a 12, 15x cash on cash return. So we also believe in having a big network, of having lots of angel investors, families, corporates as LPs in the fund, and grow a network and create opportunities for them to meet each other. Just to wrap up on this topic, I've written a book. I've written a couple books that I've written in a bunch of languages, 2 on venture capital and 1 called Masters of Blockchain. And before I forget, I'm hosting an ugly holiday sweater party at my house on the 15th of December. So if you're anywhere near Austin, I'm part of the great migration from Silicon Valley, although we're still pretending to be there. And anyone who's on this call from Randy and Nathan is welcome to join a bunch of VCs, family offices, and VC-backed entrepreneurs with an ugly, ugly sweater.
That sounds fantastic. I just pulled out a pretty ugly one out of the Christmas bin this weekend here, Andrew. So I thought of you there, and looking forward to getting together again soon. Okay. Thanks for being on today. And next we'll go up to Craig. Craig, thanks so much for being on the panel today.
Thank you, Nathan. Hello, my name is Craig DeCruz. I'm the COO of Inverted Ventures. We're a family office based out of Calgary, Alberta, Canada. Personally, about myself, I've been for 20 years. I have experience trading public equities. I've also spent 22 years in the restaurant industry as an executive chef for large hotels such as Marriott, Delta, large convention centers, and the University of Calgary. This gave me a massive understanding of how to run large organizations and groups of diverse people. It also helped me understand P&Ls, quarterly and yearly financials, how to read between the lines of those documents, which helps when you're investing, through the family office with venture capital, different companies. I'm also an avid poker player, which I believe helped me develop my skills at financial analysis, being able to read people, analyze that people are being forthright. And I also transitioned into my role as COO of Inverted Ventures and joined them in November of 2020. And I pretty much, I helped develop the Inverted Research Framework and Operation Strategy.
That's quite a background there, Craig, and that's we love the renaissance, the entrepreneurial, all the way from public trading to chef to poker playing to now to family office investing. That's great. Thanks so much, Craig, for sharing your background. Nick, over to you. Love to learn a little bit more about yourself, your background, and then we'll go ahead and jump into the topic at hand and chat a little bit about kind of the family office components. But why don't you start on the personal side?
Well, fabulous. Thank you, Nathan. Hi, everyone. My name is Nick Rodrigues. I'm the founder and CEO of Inverted Ventures. Inverted Ventures was started because of 2 separate reasons. One, which I'll expand upon when discussing family offices, we felt a need in our family to professionalize the management of capital to last for generations. And on the other side, which I learned through my business background, working in marketing and in business development for various different fintech companies, I realized that blockchain was going to be the future. It was going to be the asset class, the emerging asset class that could experience potentially asymmetric exponential gains. So in the process of formalizing our family investments, we chose to expand extensively into investing into blockchain technology in order to have access to that potentially asymmetric asset class. And this happened at the beginning of 2020. And since then, we've been actively risk managing our positions in cryptocurrencies, as well as expanding into other asset classes, such as in private equity investments and an involvement in the Keiretsu network.
Thanks so much, Nick, and to Craig and Andrew for the quick introductions there. We'll jump into the topic here, and I think for our discussion today, we've got a nice parallel between obviously the growth within the blockchain technology, digital asset community, and also this growth within the family office community, this huge wealth transfer that's happening simultaneously with this technology innovation implementation, the Web 3.0 component. So it's interesting to look at how those are mutually reinforcing, how they're separate, but how the obviously components of the investing strategies really do bring these two together in some pretty unique and interesting ways. You know, how do we get this wealth transferred, and what is the future of investing look like, and how does that actually happen? And are we, you know, at the early stages of what will be a significant transformation? Predicting the future has been very, very interesting. So as we kind of look out in the crystal ball, Nick, talk a little bit about kind of your guys' strategy. You know, why did you set up a family office? What was the purpose of that? You talked a little bit about it, but maybe a little bit more of the nuts and bolts in terms of kind of how you guys are set up, what you look like as compared to kind of historical, the Rockefellers, the Gates, the Allens, more of your traditional kind of family office groups that folks may have heard of as we were growing up, and over the years, more philanthropic organizations. Talk a little bit about kind of just the overall structure and strategy and what you guys have put together.
Absolutely, Nathan. Thank you. So Inverted Ventures was founded in the beginning of 2020, before the pandemic, with the understanding that in order to better structure our investments as a family, we needed to professionalize our investment strategy. So by incorporating and organizing through the Inverted Ventures brand, we decided to explore various different potential early stage technologies to invest in. Well, starting a company in January of 2020 was a very fascinating experience, given that not 1 month later, the bottom fell out of the stock market just after all-time highs in February. The coronavirus pandemic, of course, has absolutely changed the way that we look at the world and the way that people invest. From our side, what we saw was a collapsing macroeconomic framework where people just didn't understand how to respond to this new world we lived in, where everything was done over Zoom, where investing was done by professional hedge funds, as well as organized groups of young Wall Street bets participants off of the Robinhood app. But what we realized was we had a potential exponential opportunity by investing in cryptocurrency. So first, I'm going to jump into why do family offices exist and why are family offices an interesting and growing framework for investments. So the purpose is to professionalize investment strategies. Families have a various different from hedge funds in that high net worth families want to structure their investments and their professional networks so that they can preserve wealth within their family for generations and grow it past the point of just the initial family business where the wealth originates. In our case, I am the second generation of the family, and the previous company is a commodities logistics and trading company. So now we realize, well, having the entirety of a family net worth in the commodities industry versus structured across various different investments is not healthy for future success. So there are multiple different types of family offices. Some actually do integrate that original business in with the framework of the newly developed family office. In our case, and several others, we run a single family office where we're trying to take all of the extracted capital that we still want to generate returns and invest it in areas where we see we can finance paradigm shifts. So we saw that in early spring of 2020, after gathering all of our capital for investment that we just didn't want to allocate during a really serious sell-off due to the coronavirus, we saw that May of 2020 was going to have a Bitcoin halving event, which is usually indicative of the start of a new cryptocurrency bull market. And we saw at that point that it could potentially be what scales when everyone's stuck at home looking for something to invest in, when 40% of every US dollar created in history has been created in the past year and a half. We saw that having a disinflationary asset with Bitcoin, and now post the EIP 1559, seeing the deflationary structure within Ethereum, we saw a potential investment opportunity that could actually outperform any other asset class. Now, it's really interesting to see the family office space evolving with regards to both the adoption in blockchain technology, as well as the new framework of how they're investing. In comparison to hedge funds, family offices are a lot more nimble and have a longer term time horizon. Family offices can pivot on a dime, whereas hedge funds have a much more complex structure of limited partners and of very key frameworks for how they're allowed to invest. One thing I'll add to that, no family office is the same, and family offices differ from each other, just as families differ from each other. They may allocate to similar resources, but as a rule, it's difficult to make broad sweeping generalizations, though one that you can make with regards to family offices is their much longer term time horizon. This is where blockchain becomes very interesting for family offices. Blockchain, cryptocurrency, it's an area of investing that's a nascent asset class. At the beginning of 2020, a sub-trillion-dollar asset class. Now we're sitting slightly above the $2 trillion mark. It's still nascent when you compare it to the size of the global equities markets, bond markets, foreign exchange markets, when it's literally creating the rails for future financial and, in general, the evolution of the internet going forward. This is the movement from Web 2 to Web 3, a decentralized internet where we are able to custody our own assets. The potentially asymmetric returns offer an opportunity not just for venture capital investors, but also for retail investors. It is the only time where you are seeing retail investors have the same potential asymmetric return that accredited investors had with early stage venture capital investments. So this provides an opportunity for younger people who just don't have the same access to capital, nor the types of incomes relative to purchasing power that past generations had, that they can allocate to a highly speculative, highly volatile, yet over long term, a highly predictable market. And in doing so, they can actually gain allocation to the fastest adoption of technology in human history. So that's a bit on the family office space, a bit on blockchain investing, and I'm happy to expand later. Thank you, Nathan.
Excellent. Thanks so much, Nick, for the great background, great story, great evolution. And that's another thing about family offices. They've got a background, they've got a story, they've got human beings driving the decisions, much like angel investors early in the 90s. And like to jump down to Andrew here and get his perspective. Obviously, things have changed a lot since he began raising capital investing in the 90s to today in terms of providing liquidity for entrepreneurs, for founders, all the way through to where we are today. So Andrew, love for you to chat a little bit about kind of how you've seen family offices evolve here the last 20 years and the kind of the providers of liquidity, the secondary markets, and what you see as the outlook here for blockchain going forward.
Okay, a couple of questions in there. I think my experience with family offices is working with them as limited partners in our fund. So they invest capital in our fund and we get to know them over a period of many years. And I think that some are born like third generation or super organized, where they've got a certain percentage in the US publicly traded equities, emerging publicly traded equities, commercial, residential real estate, fixed income, private equity, hedge funds, alternative asset class that venture capital falls into. And typically, if you made your money outside of tech, you probably want to optimize for 5 to 15% of your big pizza pie is in venture capital. I think what happened with the 01 and 08 economic downturns people stood back and said, well, venture did well, so let's put more into that. And that almost hurt venture capital, that the big funds on Sand Hill Road that were like 300 million then became $1.2 billion funds. The $50 million fund became a $350 million fund. And they started writing much, much, much bigger checks. But the other kind of family offices where, I'll give you one example of a guy in Tokyo, in Japan. He was second generation, realized he's got all of his asset in one company and was smart enough to list it on the Nikkei to get public. And then he's like, all right, well, I should start divesting towards that other pizza pie the other one is describing. You typically wouldn't go all in, so that's typically what we see. On, liquidity, I think one of the most interesting things happening when you take that family office perspective of looking at the whole pizza is that, in the publicly traded markets, so not talking crypto, but regular, I think of Michael Douglas's character, Gordon Gekko, in the movie Wall Street. Greed is good. He goes to prison because Charlie Sheen was getting him insider trading information on the motorcycle about that Blue Star or whatever it was. And as soon as the rest of the world gets the memo on Blue Star, he sells and flips when it goes up. So he makes a lot of money and he gets punished and he goes to prison. I think it's interesting to see the blurring between the private markets and the public markets, and even that retail investors can participate in crypto because it's hard to stop them. That in our world of venture capital, we're not a hedge fund. We do not invest in publicly traded companies with our limited partners' money. And we invest in privately held companies where, as a preferred investor, we literally legally get information rights. Like, I would never invest without information rights. So we're like a perfect Gordon Gekko on what's happening. And then we have pro rata equity rights. If I buy 10% of a company for $1 million at a 10 million valuation, and then they go and raise money at billions, I could almost crypto programmatically put more money into that company based on my pro rata equity rights. So the idea that you invest in a bunch of companies and you've got information that the market does not have, and then you've got the ability to help them while you look like a hero helping them, but you're getting information and you're doubling down in your winners. To me, that makes perfect sense. And, the public markets are a little bit more of a mystery of you're either going to prison or you're not, delivering alpha. I'm talking about blockchain. That's just such a big topic, Nathan. I don't want to monopolize, all the microphone time, but I think, to me, what I'm most interested in, most people are not. What I'm most interested in is this just nature of the distributed ledger can make it impossible to lie. And that the nature of a smart contract, you can programmatically pay someone, as opposed to be like, do I want to pay Randy? Do I not want to pay Randy? Well, if Randy's got a smart contract, Randy gets paid. He just gets paid. So I think that's a fascinating seismic shift. But the biggest one is my bank cannot lie to me if I withdrew $100 or $1,000 from the ATM if they don't control the ledger completely. And I think that's just amazing. I'll say this on crypto and I'll pass it back to you guys. And I love hearing Nick and Craig talk on this, but I think everything is really going to be crypto. It's just a matter of time. So if you buy Microsoft stock, they're just going to digitize that and you'll be able to sell your Microsoft and swap it atomically right into Bitcoin or right into Apple. And then, and when you think about that, that means if I go to buy a computer in an Apple store, I might upload fiat to my Apple stock account, buy the computer with my Apple crypto stock, really just stock, not crypto. And by buying it with their stock, they'll give me like free technical support. And if I buy Microsoft Windows, I'm buying it with Apple stock that gets paid to Microsoft. That's now like a treasury management question. Are they long on their stock or are they long on Apple stock? And they've got Gordon Gekko insider information, like who's about to buy Salesforce or something. So I think the whole capital markets is just way more interesting to me, even intellectually, than it was, before I went down the rabbit hole. So I'll shut up there.
All right. Thanks, Andrew, so much for that perspective. And over to you, Craig, I think to kind of round us up here on the diversification components in terms of going from public equities, seeing that for 20 years, and then getting involved in digital assets, which we all have gotten an MBA crash course in that the last few years, and fortunately been able to benefit from the run up of that technology in the market. But now you guys have an additional diversification strategy from digital assets into venture. Maybe chat a little bit about kind of that initiative and kind of how you see the balance in your guys' direction going forward.
For sure. Yeah, I believe that one of the big fundamental shifts that we're seeing when the company first started, we started with a certain amount of capital. And as of today, we've already done a 12x multiple on that capital based on solely on the crypto market. So what we see is an area to diversify. We've had the Bitcoin halving in May of 2020. We've seen the parabolic run that a lot of these coins have gone on that we've invested in as well. And what we knew was that we wanted to diversify and get into venture capital. That's why we did join Keiretsu, and we joined Keiretsu based on the fact that we knew that we'd be able to get a lot of help in an area that we didn't know a lot about. And what we've learned is, due diligence, just like Andrew was talking about, pro rata rights, information rights, all these things were pretty much Cantonese to us. And what we know now is, we've learned all these things. And what we can see is that based on the venture capital model that we're looking at, potentially when you're investing in these companies, and if you're looking at things the right way and trying to decipher, who's being forthright, who's not, which company has the area to go parabolic, you can invest and get the same returns on a venture capital company that you can get out of the crypto market. I think one of the big things that we're looking at as our family office is the fact that, investing in the equities market, you're not necessarily going to get, people are talking about, an 8% return. Oh, that's great. 8% is great over a year. Well, Ethereum went up 8% in the last 24 hours, right? So we're looking at how do we maximize our returns, but in a safe manner for our company, for our family's wealth over generations. But also, I think the big switch that we're looking at is that from a venture capital model, just like Andrew said, I believe that's going to get digitized as well. Everything that we do is going down that route where it's going to be digitized, decentralized, because it keeps everyone safe. It keeps everyone honest. It's very hard to lie on the blockchain. So I think that's going to be one of the big narratives going forward it's going to help switch things. It's going to go from, it's a little bit shifty to now it's safe. It's helpful for everybody that's using it. It's going to help companies, businesses, young people do things better.
Thanks, Greg. We'll go ahead and open it up. Again, if there's any questions, please drop those in the chat window and question module. We'll try and get in as many questions as we can here in the time that we've got left with our wonderful panel. Nick, love for you to jump in a little bit too and just chat a little bit about how you see the allocation strategy. How much should family offices be looking at crypto versus, venture equity versus, where do you see kind of a prudent, allocation of the time and effort, the resources versus, funds and other folks who are specialists in specific areas. How do you see the kind of the allocation effort between those two areas?
I think with regards to allocation to various asset classes, I really believe that has to do with two fundamental factors. One is the types of risks the family wants to take. Do you have a volatility preference, a liquidity preference? If you want to lock in capital for a long period of time and make consistent returns, as a family office, allocating to a hedge fund or a venture capital fund might be the right choice for you. In our case, a large reason why we really like cryptocurrency is because we have a massive liquidity preference, and we want to have the option of being able to move our capital around as much as we want, especially given cryptocurrencies are extremely volatile, and there does tend to be on average a 2-year bull market, 2-year bear market cycle that takes place and has over the past 3 cycles. To answer more about a specific allocation to cryptocurrency, not to talk our book entirely on this panel, but we are very highly weighted towards Ethereum in comparison to Bitcoin. A large reason for that are the supply-demand fundamentals within that aspect of cryptocurrencies. Looking at Ethereum, the EIP 1559 improvement to the Ethereum blockchain led to all gas fees being burnt, meaning that there is actually a decreasing supply of Ethereum when there is more usage on the blockchain. Another side that's really important to look at when talking about the disruption in supply on the Ethereum blockchain is the amount of Ethereum locked into the ETH 2.0 staking contract, which is illiquid, in that there will not be a liquidity event until, correct me if I'm wrong, Craig, sometime in 2022. On the other side, there's still quite a bit of capital locked into DeFi, meaning there's roughly 10%, and I know Craig's going to check me on these metrics, roughly 10% of Ethereum's total supply that's available on exchanges, where institutions see Ethereum as one of the main areas they can allocate to with a better risk reward than a lot of projects like, projects that are scaling much more quickly in terms of what they can provide users at lower fees, such as Solana, Luna, Avalanche, a few other protocols as well, or layer 2 protocols on Ethereum like Matic and potentially Arbitrum as well. These areas, if you're an early stage retail investor and you want to maximize your risk, you're going to jump into those. They're just further out on the risk curve than something like Ethereum. But at this point, retail investors want to build an allocation to Ethereum. Institutional investors want to build an allocation to Ethereum. And this is a large reason why that taking place at the same time as these massive supply constraints, we really believe that Ethereum will outperform Bitcoin over the near future. So that's, I think that's a good explanation of kind of where we see cryptocurrency markets. But even though we're bullish on Ethereum, we are still very heavily weighted towards those other layer 1 protocols that I listed, such as Avalanche, Luna, Solana.
Thanks, Nick. Kareem, do we have a couple more minutes, or how much time more you want to give us here?
A couple of minutes, because I took away a couple from you before, but I do have a question to close out as well. So give me an opportunity when you have a chance.
All right. So just wanted to go back to Andrew with one more thought here. Andrew, one of the challenge with early stage investing, it's tough. It's a long-term game. It's generally been illiquid, and we're not quite tokenized yet, although we just did a deal yesterday that was half tokens, half equity. So I think that's going to be a little more of the future of what we see, particularly for companies in this space. But can you talk about, within your fund structure, what have you done to try and accelerate liquidity for your LPs and for family offices out there looking to invest in technology? What are some of the things you see changing in the landscape in terms of liquidity for LPs, liquidity for entrepreneurs within that secondary market?
It's a great question, because it's changed and evolved so much over the last 15, 20 years, really. It used to be very taboo for the founder to sell any shares before the final definitive IPO M&A liquidity event for the company. And it was also sometimes viewed as you're not the greatest venture capitalist. If you're selling early, you should shoulder and fight right till the end of that World War I trench you're in. Whereas now the funds got so big, if I'm the first investor in the company and I'm ready to sell 10% at $1 billion valuation when I was in at 8 million, everyone's happy that there's some inventory to deal with their ownership target percentages. So the mentality is completely shifted, that anybody who wants to sell at any time on a good, well-performing company is can get liquid. We've got an investor in our fund out of Dallas that's willing to provide liquidity to any LP at the LP layer to get out at any time, which makes it a completely liquid asset class. But what we're doing is we'll invest in about 25 companies with about 30% of our cash. So that's a diversification model. And those are pretty early stage, like $1 million in revenue, some a little bit earlier, some later. And then we're doubling down with about 70% of our money into our winners to kind of capture that, frankly, Gordon Gekko legal insider thing. But then we think so we're investing a second time at a higher valuation. But when they start just going crazy, which in 2021, they really have been doing much faster, we say, why don't we sell 5% of this one? So 5% of that one company that the fund is an owner in, and sell maybe 10% of that and 25% of that, and say, is that enough to return the entire fund between month 12 and month 24, or between month 12, maybe month 36 if it slows down? But normally companies raise enough money to give themselves an 18 or 24-month runway. So they raise more money, they spend more, their revenues are up, but they're going to hit zero by month 24 or 18. They usually come back and raise another funding round, maybe 6 months before they run out. Now a round is done, my phone rings, and I get all these messages from other VCs saying, hey, I saw you just funded that. Can you introduce me? Tell me about it. And I'm like, sure, why don't you invest at twice the valuation that we did a week later? Like, this is literally happening every week right now. And I love it. So if they go up again that fast, I'm saying, why don't we return the fund a bit faster? But I always feel like I'm kicking myself in the nuts to sell early when I know this company is going to go up again, and it's going to, like Nick's conviction around Ethereum, which I agree with. When you feel like you know that, you're like, oh, I'm selling too early. This is terrible. So what we do is we say to every LP, you're all adults. If you want, you can take the cash from this one, that one, and that one, or you pick, or recycle and stay in the SPV, the special purpose vehicle, so you're not selling now, and you can ride that one longer. But it's your choice. Some people just got divorced, or they want to buy some Ethereum, and they need the cash now. And other people say, I think it'll 5x, 2x, 4x from here. And then they can, so it's 1, take the cash, 2, recycle, or 3, recycle and double down and wire more money. If someone makes a 4x, that'll do damage to a fund seeking to make a 10 to 15x. But if you want to upgrade your airplane and stop for gas not as many times, you do 5 million in that, you get 10 million or 15 million back, sell the airplane, and there you go. Each person's different. I don't have the airplane problem myself.
All right, thanks, Andrew. It's certainly a different world evolving here in terms of liquidity for early stage entrepreneurs. It is a great time to be investing. And, why do we do it? Obviously we're here to get a return and to be able to generate hopefully generational wealth and keep that going generation to generation. But, we also want to make a difference as well. And so family offices are really driven by a lot of different factors and core values, and impact can be one of them. And just wanted to finish up with Craig here, chat in a minute about kind of what's the impact component of your guys' family office strategy, and maybe just detail out why that's important to you guys as well.
For sure. We're very much interested in identifying paradigm shifts that'll change the human experience. Our big goal as a fund, as a company, is to invest in things that are going to help people, whether that be education. With my culinary background, I think food scarcity, clean water, world hunger, things like that are so huge to us. How to minimize plastics, there's all these different things that we're looking to invest in and have invested in on the venture capital side, that we're going to take the assets that we've gained by investing in cryptocurrency into the venture capital side to invest into things that we actively care about. That's our whole mantra. That's our mission, is to take our capital and use it for good. And I think that a lot of family offices that we talk to, that's their goal as well. Right now, there's, with carbon credits and with, clean energy use and green energy, all these things are coming up, that these are areas that family offices and investors can get into, make a difference, and make a buck. And I think that's a huge value add.
Certainly is, and sorely needed, that long-term patient capital with a force for good impact. Again, we've got 10 trillion now going up to 65 trillion. I think this is the bet, and how it gets allocated is going to really make a huge difference for the future. So appreciate you guys being leaders in this area and on the forefront, and connecting, wanted to build community and be together with other smart investors. So please do complete the Zoom poll if you'd like to connect with any of the panelists up here, learn more, or connect with us. We're happy to provide resources and support. And obviously, we'll be doing additional events and activities with Link 2 here in the future. So, Kareem, did you have a final thought, question
Thank you.
you want to wrap up with?
Yeah, thank you, Nathan and Nick and Greg and Andrew. It's been a pleasure to be here with you today. Obviously, we'll see you in Portugal, and we'll dive deep into the crypto and that asset world. Thank you for allowing your participation in Lisbon. Looking forward to seeing you there.